Imagine waking up one morning and realizing that while you were sleeping, someone else was paying down your mortgage, covering your expenses, and building your wealth. That's the power of owning a rental property. The truth is, most people dream about buying real estate, but never take the first step because they think it's too complicated, too risky, or reserved only for the wealthy. But in 2025, with new opportunities in the housing market, updated lending rules, investment, and smarter tools for investors, it's more possible than ever to buy your first rental property, even if you've never invested before. This isn't about chasing a get-rich-quick scheme. It's about creating steady, reliable income that grows with time and building a foundation that can set you up for financial freedom. When you're preparing to buy your first rental property in 2025, the very first step is clarity. Clarity about the market, investment, and clarity about your goals. Too many new investors make the mistake of jumping in without truly understanding what they want their investment to achieve. Do you want to build long-term wealth through appreciation, investment, or are you more focused on monthly cash flow that can provide you with extra income right now? These two goals often lead you to completely different kinds of properties and markets, so knowing where you stand will save you from costly mistakes. For example, someone who wants strong cash flow might be better off looking at affordable rental markets with higher yields, while someone who's focused on long-term equity growth might be more inclined to buy in a city that's experiencing rapid development and job growth, even if the short-term rental income is lower. The 2025 housing market comes with its own unique dynamics. Interest rates have shifted compared to previous years, supply chains have improved after years of volatility, and rental demand remains strong in many urban and suburban areas. This creates opportunities, but also risks if you're not paying attention. The best way to understand your market is to do your homework, study local neighborhoods, research average rent prices, track vacancy rates, and look at population trends. Is the area growing, or are people moving away? Are there new job opportunities nearby, or is the local economy struggling? These factors determine whether a property will be a financial asset or a constant headache. Investment. Remember, the right market can make up for mistakes in property selection, but the wrong market will ruin even the best property. Setting clear investment goals also means defining your time horizon. Ask yourself, are you looking for a property that can generate consistent rental income for the next 10 years? Or are you planning to sell after a few years to capture appreciation? Your answer will shape how you approach financing, how much risk you can take, investment, even what kind of tenants you should be targeting. For example, if your plan is long-term cash flow, you'll want to prioritize properties in stable areas where families want to settle down, because those tenants often stay longer and provide more consistent income. But if your goal is appreciation, you might focus on emerging neighborhoods where property values are expected to rise, even if turnover among tenants is higher. Another part of understanding the market is recognizing what makes 2025 different from previous years. With technology, you now have access to more data and tools than ever before. Platforms can show you rent estimates, projected returns, and even detailed neighborhood statistics at the click of a button. But while technology makes it easier to access numbers, it doesn't replace the need for human judgment. Visiting the neighborhood, talking to local realtors, and even spending time at nearby coffee shops or grocery stores to see who lives there can give you insights that data alone cannot. The combination of hard numbers and first-hand experience will put you miles ahead of investors who rely only on online searches. You also need to be realistic about what kind of property fits your current situation. A single-family home might be easier to manage and attract stable tenants, while a small multi-family building could generate higher income but require more maintenance and involvement. Neither option is automatically better. It depends on your tolerance for risk, your management style, and your financial goals. In 2025, affordability is a key consideration because while rents have risen, so have property prices in many areas. Makes a good investment. This means running the numbers carefully and making sure you don't overextend yourself just to buy something quickly. When you're setting goals, don't just think about the next year. Think about the next decade. Real estate is a long-term game. The rental property you buy today is not just about the cash flow or appreciation in 2025. It's about the foundation you're laying for 2030, 2035, and beyond. If you align your goals with the realities of the market, you'll be able to make decisions that keep you on track even when the economy shifts. There will always be ups and downs in housing, but investors who plan carefully and focus on fundamentals tend to come out ahead. Finally, remember that your first rental property doesn't have to be your last. In fact, most successful real estate investors will tell you that their first property was more about learning than about making a fortune. If you go in with the right expectations, clear goals, a solid understanding of the market, and a willingness to learn, you'll not only reduce the risk of costly mistakes, but also set yourself up for the kind of momentum that allows you to grow a portfolio over time. The first property is the hardest, But it's also the most important because it teaches you how to think like an investor. And in 2025, when opportunities are there for those who are prepared, the combination of market understanding and goal clarity can turn that very first purchase into the start of something much bigger. Buying your first rental property in 2025 isn't just about finding the right house or apartment. It starts with building a strong financial foundation. Without this, even the best property can turn into a burden. Too many new investors underestimate the importance of their financial readiness and end up struggling with unexpected expenses, higher mortgage payments, or difficulties qualifying for loans. That's why your ability to set yourself up financially is just as important as your ability to identify a good deal. The very first step in building this foundation is to take a close look at your credit profile. In 2025, lenders are more cautious, and a strong credit score can mean the difference between getting a competitive interest rate and paying thousands more over the life of your loan. A higher score doesn't just save you money. It can also increase your borrowing power and flexibility with different loan products. If your credit isn't where it should be, this doesn't mean you can't invest, but it does mean you should focus on improving it before applying. Paying down high interest debt, keeping credit utilization low, and ensuring there are no errors on your credit report are all steps that can quickly strengthen your position. Next, you need to understand your financing options. Traditional 30-year fixed rate mortgages are still popular for investors because they lock in predictable payments, but they aren't your only choice. In 2025, many lenders are offering products tailored for investors, including adjustable rate loans, debt service coverage ratio, ISCR loans that focus on rental income instead of personal income, and portfolio loans that allow you to scale faster if you plan to buy multiple properties. Each of these comes with benefits and risks, so you need to match the financing with your investment goals. For example, if you want to hold a property long-term, locking in a fixed rate might give you stability. But if your plan is to buy, improve, and sell within a few years, an adjustable rate loan might save you money in the short term. Part of your financial foundation also involves having adequate reserves. Many new investors underestimate how much cash they'll need after the down payment and closing costs. You'll face expenses like repairs, maintenance, vacancies, and property management fees. If you don't have a cushion, even a single bad month can throw off your entire investment. A good rule of thumb is to keep at least 3 to 6 months of expenses set aside specifically for your rental property. This doesn't just protect you financially, it gives you peace of mind, allowing you to handle problems without panic. Budgeting for hidden costs is another crucial part of this process. It's easy to focus on the mortgage payment and expected rent, but successful investors know that the real numbers are in the details. Property taxes, insurance premiums, utilities, investment, and even small recurring expenses like lawn care or pest control can add up quickly. If you're managing the property yourself, your costs may be lower, but if you hire a professional property manager, you'll typically pay 8–10% of the monthly rent. In 2025, with property taxes and insurance premiums on the rise in many markets, overlooking these details can wipe out your profits. Before buying investment, run a complete breakdown of every possible expense and make sure the property still cash flows. Another element of financial readiness is managing your personal budget. Real estate investing works best when it doesn't strain your everyday life. If you're stretching too thin to cover a down payment, or if your personal expenses are eating into your reserves, you may find yourself in a stressful situation. Take the time to optimize your personal finances, track your spending, cut unnecessary costs, and free up cash flow that can be redirected toward your investment. This not only strengthens your financial foundation, but also builds the discipline that will carry over into your investing career. It's also worth thinking about your long-term financing strategy. Buying one property is exciting, but if your plan is to build a portfolio, you'll need to understand how lenders view multiple mortgages and how your debt-to-income ratio impacts your ability to keep growing. By planning ahead, you can avoid bottlenecks that prevent you from scaling when you're ready for your second or third property. In 2025, some investors are even turning to partnerships, real estate investment groups, investment or creative financing options like seller financing and lease to own agreements to expand faster without tying up all of their personal capital. Ultimately, building the right financial foundation is about more than just qualifying for a loan. It's about ensuring that your first rental property helps you build wealth rather than drain it. By strengthening your credit, exploring financing options carefully, maintaining reserves, and budgeting for every hidden cost, you're setting yourself up for success. Remember, real estate is a long-term game. The property you buy today will only be as strong as the financial position you bring into it. With a solid foundation, you'll be ready not just to buy your first rental property in 2025, but to continue building on that momentum for years to come. When it comes to buying your first rental property, one of the biggest lessons you'll learn is that not every property makes a good investment. Many first-time buyers make the mistake of falling in love with a house or apartment based on how it looks, the neighborhood's reputation, or simply because it feels right. But investing in real estate isn't about emotions. It's about numbers. In 2025, with property prices in many areas still elevated and demand for rentals remaining strong, the difference between a profitable rental and a financial headache comes down to your ability to analyze deals with precision and discipline. The first step in finding the right property is learning how to calculate cash flow. Cash flow is the lifeblood of a rental property. It's what's left over after you've paid all expenses, including mortgage, property taxes, insurance, repairs, maintenance, and property management if you use one. To calculate it, start with the expected rental income and subtract every possible expense. Too often, new investors only consider the mortgage payment and property taxes, ignoring other costs like vacancies, maintenance, or insurance hikes. This is a mistake that leads to properties looking better on paper than they perform in reality. A property that generates consistent positive cash flow, even after conservative expense estimates, investment, is far more valuable than a property that looks pretty but bleeds money every month. In 2025, one of the advantages you have as a new investor is access to tools and data that can help you estimate cash flow with more accuracy than ever before. Online calculators, rental estimate platforms, and real estate data services can provide information on comparable rents, neighborhood vacancy rates, and even projected expenses. But these tools should be a starting point, not your final decision. Always verify by looking at actual rental listings in the area, talking to property managers, and getting insurance and tax estimates directly from local sources. Numbers from a national database may not reflect the reality of your specific property or neighborhood. Beyond cash flow, you also need to learn how to estimate repair and renovation costs. A property that looks like a bargain because of a low purchase price can quickly become a money pit if it needs a new roof, major plumbing upgrades, or structural repairs. Walk through the property with a critical eye, or better yet, bring a contractor or inspector who can point out potential issues. Even cosmetic upgrades like paint, flooring, or appliances can add up quickly, and if you don't budget for them, your initial returns will suffer. Smart investors in 2025 aren't afraid of properties that need work, but they know exactly what the work will cost and factor it into their analysis before making an offer. Investment. Another crucial part of finding the right property is understanding tenant demand. It doesn't matter how great the numbers look on paper if you can't find reliable tenants. Look for areas with steady population growth, access to jobs, schools, and transportation and amenities that tenants value. Drive around the neighborhood at different times of the day. Are there signs of pride of ownership, or do you see neglected properties and high turnover? Investment. Talk to locals and property managers about what kinds of rentals are in demand. For instance, in some areas, smaller one-bedroom units might be difficult to rent, while in others, they're in high demand. Aligning your property choice with what tenants actually want will reduce vacancy and ensure stable income. Price also plays a huge role. Just because a property is listed at a certain amount doesn't mean it's worth it as a rental. You need to be disciplined about walking away from deals that don't meet your criteria, no matter how much you like them. This is where using metrics like the 1% rule or cap rate can be helpful as a quick filter. The 1% rule suggests that a rental property should generate monthly rent equal to at least 1% of the purchase price. While this rule isn't perfect and may not apply in all markets in 2025, it provides a good benchmark to quickly weed out overpriced properties. Cap rate, on the other hand, measures a property's return based on net operating income divided by its purchase price. Investment, giving you a way to compare different investments objectively. It's also important to remember that the right price isn't just about what the seller is asking, it's about what you negotiate. Many successful investors buy properties below market value by targeting motivated sellers, foreclosures, or properties that need minor improvements. In 2025, as interest rates and affordability challenges create stress for some homeowners, opportunities may arise for buyers who are ready to move quickly with financing in place. By staying patient, running the numbers carefully, and making offers based on investment logic rather than emotion, you increase your chances of securing a property that sets you up for long-term success. At the end of the day, finding the right property at the right price comes down to discipline. It's about sticking to your criteria, running the numbers honestly, and being willing to pass on dozens of properties before finding the one that works. Your first rental isn't about finding the perfect dream house. It's about finding a solid investment that makes financial sense. If you approach it with the mindset of an investor rather than a home buyer, you'll avoid the traps that catch many beginners and put yourself on the path to building a profitable portfolio. The best investors in 2025 are those who combine data, analysis, and patience to turn opportunities into long-term financial growth. Owning a rental property is often portrayed as a simple way to build wealth. You buy the property, rent it out, and collect a check each month. But the reality is far more complex. The difference between a property that creates long-term wealth and one that becomes a financial burden is how well you manage risks and prepare for the unexpected. In 2025, with rising costs, evolving tenant expectations, and a shifting economic landscape, protecting your investment isn't optional. It's essential. This means looking beyond the excitement of your first purchase and building systems that make your rental a sustainable source of income. The first risk to manage is tenant related. Your tenants are the lifeblood of your rental business investment, and choosing the wrong ones can cost you months of lost rent, property damage, and endless headaches. Screening tenants carefully is one of the most important steps you can take. This includes checking credit history, verifying income, contacting previous landlords, and conducting background checks where possible. It's tempting to rush this process, especially when you're eager to fill a vacancy, but a single bad tenant can destroy your cash flow. In 2025, tenant screening technology has become more advanced, giving landlords access to streamlined platforms that make the process easier and faster. Use these tools to your advantage, but never sacrifice diligence for speed. Once you have good tenants in place, the next step is maintaining positive relationships. This doesn't mean being overly flexible or tolerating late payments, but it does mean treating tenants with respect, addressing issues quickly, investment, and communicating clearly. Tenants who feel respected and well cared for are more likely to pay on time, stay longer, and take better care of your property. Long-term tenants reduce turnover costs, minimize vacancies, and ultimately increase your returns. Think of tenant management not just as enforcing rules, but as cultivating a professional relationship that benefits both sides. Another risk you must prepare for is unexpected expenses. Even if you've budgeted carefully, things will break, roofs will leak, and appliances will wear out. One of the fastest ways new landlords fail is by underestimating these costs. The key is to create a reserve fund dedicated solely to your rental property. A good rule of thumb is to set aside at least 5-10% of your rental income each month for repairs and maintenance. In 2025, inflation and labor shortages in some areas have pushed repair costs higher, making it more important than ever to budget generously. By having reserves, you'll be able to handle problems immediately rather than letting them spiral into bigger, more expensive issues. Insurance is another critical layer of protection. A standard homeowner's policy won't cut it for rental properties. You'll need landlord insurance, which covers risks like tenant damage, liability if someone gets injured on your property, and lost rental income in certain situations. Depending on where your property is located, you may also need additional coverage for floods, earthquakes, or other natural disasters. While paying insurance premiums may feel like a burden at first, the protection they provide is invaluable. One major event could wipe out your profits for years if you're not covered properly. Risk management also extends to how you structure your ownership. Many investors in 2025 are choosing to hold properties under limited liability companies, LLCs, or other legal entities. This provides protection for your personal assets in case of lawsuits or claims against the property. While setting up an LLC involves some upfront costs and paperwork, it can be a worthwhile safeguard as you expand your portfolio. Investment. Consulting with a real estate attorney or tax advisor can help you determine the best structure for your situation. Beyond risk, managing your property effectively is key to turning a single rental into long-term wealth. Some investors choose to manage their properties themselves to save money, while others hire professional property managers. Both options have pros and cons. Managing the property yourself can save thousands of dollars per year and give you direct control, but it also requires time, availability, and knowledge of landlord-tenant laws. Hiring a property manager reduces the workload and can be especially helpful if you own multiple properties or live far away, but it cuts into your profits. The best choice depends on your goals, lifestyle, and tolerance for involvement. Long-term wealth also comes from reinvesting your profits wisely. Instead of spending all the cash flow, consider using a portion to pay down the mortgage faster, fund upgrades that increase rental value, or save toward your next property. The compounding effect of reinvestment is what allows small landlords to grow into large-scale investors over time. A single property might provide a modest monthly profit, but a portfolio of 5, 10, or 20 rentals can create financial independence. The key is to think of your first rental not as the end goal, but as the foundation of a larger strategy. Lastly, it's important to keep educating yourself and adapting as the market changes. Investment, tenant laws, tax codes, and market conditions evolve, and what worked 5 years ago may not work today. Staying informed through books, courses, mentors, investment, or networking with other investors will keep you ahead of challenges and help you avoid costly mistakes. Real estate is a business, and successful investors treat it as such. In the end, managing risk and building long-term wealth through your first rental property isn't about avoiding every problem. It's about being prepared for them. Tenants will move out, things will break, and markets will shift. Investment. But if you have systems systems in place, reserves to fall back on, and a long-term mindset, these challenges won't derail you. They'll simply become part of the process. In 2025, the investors who succeed are not the ones who expect perfection, but the ones who plan for imperfection and build resilience into their strategy. Your first rental property can either be a stepping stone to financial independence or a source of endless stress. By managing risks wisely and focusing on long-term growth, you give yourself the best chance of building a future where real estate works for you, not against you. At the end of the day, investment, buying your first rental property in 2025 isn't just about real estate. It's about reshaping your financial future. You've learned that the journey begins with clarity, understanding the market and setting the right goals so you know exactly what you're aiming for. You've seen why a strong financial foundation, good credit, the right financing, and solid reserves protects you from unnecessary risk. You've discovered that the real secret to finding the right property isn't about falling in love with a house, but about running the numbers, analyzing cash flow, and buying at the right price. And finally, investment. You've come to understand that success doesn't stop at the purchase. It's about managing risks, building systems, and using your first property as a stepping stone toward long-term wealth. The truth is, you don't need to be wealthy, a financial genius, or have decades of experience to start. You need the right mindset, the discipline to plan carefully, and the courage to take action. Every successful investor started with that first property, investment.
Wow.
And while it might not have been perfect, it gave them the knowledge, the confidence, and the momentum to grow. Your first rental will do the same for you if you approach it with patience, preparation, and persistence. So, investment. As you think about your next steps, remember this: real estate rewards those who act, but it also punishes those who rush. Take the time to set your goals, build your foundation, analyze carefully, and manage wisely. If you do, your very first rental property in 2025 won't just be a single investment. It will be the beginning of a legacy that can provide freedom, security, and wealth for years to come.